Now, as to non-bank risks, I want to make 5 points. First, let's look at the financial system as a whole. Banks are the most highly regulated, supervised, and transparent part of our financial system. There are hundreds of bank regulators and thousands of bank supervisors. And yet, regardless of why, they seem to fail fairly often. You know, yes, recently we've got Silicon Valley Bank, Signature Bank, and First Republic, but also let's look at Wells Fargo, years of failure upon failure, and of course the conduct in the years before the 2008 financial crash. Again, regulation and supervision failure for years. Now, I don't say any of this to bash bank regulators, but if such risks can materialize in the most regulated, supervised, and transparent part of the financial system, just imagine what the unknown, unregulated risks in the non-transparent, non-bank part of the system are. It's surprising how little we actually know about the non-bank financial system. The Fed's recent May financial stability report illustrates this. Almost every time they talk about a non-bank activity or risk, it says, of course, we don't really know because we don't have hardly any information. Put differently, if we can have very big and consequential systemic surprises in the banking sector, we need to be very, very worried about all that we don't know about the risks in the non-bank sector. Second, this isn't the way it was supposed to be. As everyone knows, the 2008 crash was caused by reckless risk-taking, if not worse, in the banking and non-banking sector. And both were bailed out by the Fed, the FDIC, and American taxpayers. The Dodd-Frank Act actually addressed both of those sectors with the intent of focusing on systemically significant financial institutions, regardless of form or function. The Fed was directed to regulate systemically significant banks directly, and the FSOC was created to identify risks in the non-bank sector and designate systemically significant non-bank risks, which were then supposed to be subject to regulation by the Fed. The intent was to ensure that systemically significant banks and non-banks were similarly regulated based on their risk profiles. But then that didn't happen. Today, according to FSOC, there is not one systemically significant non-bank in the United States. Not one is designated as such, not one is regulated by the Fed, or really anyone else for that matter. Attempts, yes. Partial, yes. Really? No. And that's true even in light of the facts previously mentioned. The non-bank sector is now way bigger than it was in 2008 and bigger than it was in 2020. And remember, like 2008, non-banks were bailed out again in 2020. Yes, it was due to the pandemic and it's not anyone's fault. But the pandemic shock was the first live stress test of the entire post-Dodd-Frank financial architecture. And it failed. People forget that not only did the Fed take rates to zero and engage in massive QE, it also revived every single one of the 2008 rescue programs for money market funds, commercial paper, asset-backed securities, mutual funds, and it even added a few new ones, junk bonds, PE, and more. Now, people can argue whether all of that was right or wrong, necessary or not, but regardless, it vividly highlights the ongoing vulnerabilities, fragilities, and risks in the non-bank sector. And that brings me to my third point, which is that too big to fail is alive and well and getting worse. It should be no surprise that too big to fail was at the core of the most recent bank crisis. Not just because non-GSIB banks were systemic, we've been saying that for years, that the GSIB focus is too narrow. Too big to fail includes what we call DSIBs, domestically systemically significant banks. And Beta Markets, along with former Fed Vice Chair and Governor Lael Brainerd and former Director, now Chair of the FDIC, Marty Gruenberg, have repeatedly pointed this out in dozens and dozens of rulemakings, speeches, public statements, testimony, predominantly after 2017, but even before. But bailed out, or if you prefer rescued, DSIBs is not the only place too big to fail distorts the financial system. The deposit of flight that Phil just talked about happened because too big to fail firms or activities were there to take those deposits. So the bottom line is too big to fail is alive, well, and getting worse. So my fourth point is how to change that isn't a mystery. Kristen Forbes made this point yesterday. Sometimes it's not so much trying to come up with new clothes to deal with old challenges. The old clothes were actually pretty good, not actually the ones in her slide, but others. People, I don't know how to run the metaphor out here, but people just didn't wear them right, maybe. As I said earlier, FSOC has to do what it was created and empowered to do. With OFR, it needs to get all the information necessary to evaluate the risks in non-bank sector so that the future financial stability reports won't say we don't have the information. Then FSOC has to identify and designate non-bank SIFI risks. The Fed then has to regulate them in a way that's similar to bank SIFIs, based on their unique risk profile. No, not one size fits all, not cookie cutter, based on their unique risk profiles. Of course, regulating systemic risks once identified isn't a mystery either. Building on a great deal of prior work, Better Markets released a policy brief just last week summarizing the 10 actions that need to be taken to reduce systemic risks. No one will be surprised because they're all well known. They're old clothes, if you will. More and better capital and liquidity. Actually stressful stress testing with public consequences. Resolution plans that work and enable certainly DSIBs, if not GSIBs, and systemically significant non-banks to be resolved in bankruptcy in an orderly fashion that doesn't involve government bailouts and support like every other company in America and as required by the foundational rules of capitalism. None of this is radical or frankly all that complicated. Most importantly, we need regulators to take action as decisively and quickly to prevent the next crash as they do when trying to stop an ongoing crash. Again, read the Fed's May Financial Stability Report. They repeatedly talk about how decisively, favorite word, decisively they acted regarding, and I'm not making fun of them, it's an accurate word. They acted regarding Signature Bank and Silicon Valley Bank. But they only otherwise identify all the ongoing risks without really proposing to do a darn thing about them. That's upside down. Now, I know that's not the purpose of the stability report, but the stability report is supposed to be consumed by somebody who then does something, and it's time to act decisively to prevent crashes now and to act as decisively now to prevent the next one as they're willing to act once one happens. And one way to do that would be to enact now a variety of interim final rules, which would be effective upon publication. And there's an ample basis to do that across the board on a number of these reforms, if you want to call them that. Fifth and finally, everyone has to remember the stakes are very, very high. This is about much more, with all due respect to Lord King, much more than models, regulation, deregulation, crashes, bailouts, rinse and repeat. While studying them is academic, these are not academic issues. The impact on the lives and livelihoods of all Americans is quite dramatic, and we're a chart deficient table over here, but I did have one chart that I wanted to bring up. When I say they impact the lives and livelihoods of all Americans, this chart is the unemployment caused by the 2008 crash, judged by the U6 rate, and it illustrates how bad it can be. And you can see that it actually reached 17%, which is about 27 million Americans who are out of work. And by the way, it peaked in early 2010. And you might remember that in early 2010, at the exact same time, Wall Street paid itself $20 billion in bonuses, according to the objective facts. There was no bailout for Main Street families. They saw that, they felt that, they lived that, and yes, look at the polls, they remember that. And they see echoes of that with what just happened. You have to remember, even a so-called soft landing is still going to land very, very hard on millions of Americans, families, and communities. And sure, a low employment rate is much better than a high one. But remember that the unemployment rate for each one of those millions of Americans who are unemployed is 100%. Those are the dire consequences that result. And that's not all. These issues also directly impact our democracy, the faith, trust, and confidence of the American people in their government, the legal system, and government officials. And that's what's actually at stake in the issues that this conference is talking about. Bailouts and favorable treatment for the wealthy and well-connected destroy confidence and trust, not just in regulators, but the entire government and, yes, democracy itself. I don't have the time to talk about it at the length it deserves, but I urge you all to read Martin Wolf's new book, called The Crisis of Democratic Capitalism. I don't agree with everything he says, and I don't expect you will either, but he starkly illustrates what's at stake when special interests, including especially from too-big-to-fail banks and non-banks, are put above the interests of everybody else. So yes, let's look at the opportunities non-banks may create for financial markets, but remember that the cost and consequences of not properly regulating bank and non-bank risks aren't just crashes and crises. It's much deeper than that. Thank you.